Wild. Okay, I want to ask about U.S. expected returns. U.S. market's been on this like crazy run for the last 20 years. I hear people all the time saying that the U.S. is going to keep getting 10% returns forever. And that the other thing people say it's crazy is like, who cares about the U.S. market? Look at QQQ; it's going to keep getting 14% returns forever. What's your outlook on U.S. expected returns?
Well, I mean, first of all, that's that complex adaptive phenomenon that you're talking about, right? So a decade ago, nobody would have talked to you about QQQ. Really, a little bit longer than that. 12 years ago, if you remember, David Einhorn, again, one of the smartest individuals I know in these markets, was highlighting that nobody was paying attention to Apple or Microsoft, right? Now, part of the reason that changed was because of the growth of target date funds that mechanically pushed that money in. But the simple reality was at that point, people were looking at the companies themselves and saying, hey, wait a second, these margins are largely unsustainable, right? Now, one of the great ironies is that when you create this type of feedback loop that advantages the largest companies with a dramatically lower cost of capital, I would actually estimate that it's a negative cost of capital for many of these companies. They're able to do crazy things like subsidize the acquisition of the highest quality labor and talent through the use of stock options, right? And those stock options in turn actually need to be exercised. That is effectively like them selling shares, right? Those shares are then mechanically bought by the index investors with
Mm-hmm.
no consideration as to value,
Hmm.
right? And so what it does is it actually becomes very much the Soros reflexivity dynamic where Microsoft and Google and Apple become endowed in a manner that the other lesser companies are not. And so it actually consolidates real resources into these entities and makes them more powerful than they really should be. Right? It's just like it's truly perverse, right? So again, if you jump back to that slide that I showed you before, and I want to be very clear, I don't think that this is ultimately going to happen because the volatility will become so extreme. But if you jump back to slide 11 that shows that exponential curve, that orange line going higher, the easiest way to think about that is as you get to somewhere in the neighborhood of 80% passive, and remember, we're only about 45% right now. At around 80% passive, the Shiller PE would be somewhere around 4 to 500,
Hmm.
right?
Man,
Sounds great, right? What's the problem?
well, you could more easily see an 85% correction maybe when P's are that high.
Well, so that is ultimately one of the things that's really important for people to recognize is like, I don't know how to say get out of the way of this thing when I can realistically look at it and say, wait a second, I think it could actually go up another 4, 500, 600, 700% simply on valuation.
Wow.
Right. Now, I don't think that's going to happen because I think we're actually approaching the inflection point where passive has become so large that it creates its own enemy. Right. And this is where it gets super interesting because remember, withdrawals are always a function of asset levels. You think about something like a 401k in the United States, you have a required minimum distribution. And again, under lobbying from Vanguard and BlackRock, they've changed the rules to keep assets in 401ks longer than they otherwise would have, right? So they're doing everything they can to stop this outcome from occurring. But you're entering into an environment in which a 4% redemption from a 401k that is appreciated 3, 4, 500% overwhelms any contribution that people could make. And
Mm.
so, ironically, actually, 401ks went negative in terms of their net contributions back in the fourth quarter of 2018. Now, we immediately changed the rules to address that. But ultimately, we can't fight it that much because of this dynamic of withdrawals being tied to asset levels, while contributions are always going to be a function of income.
Mm.
Right.
Man, so
So when you talk about like what are the returns, I have to make it completely conditional and say, do we see outflows? If we
right.
see outflows, then we unwind a massive fraction of what we've seen so far, and returns will probably be the most negative in history. Right. On the flip side of that, if we don't get to that point and they continue to change the rules and they suddenly say, hey, wouldn't it be a great idea if we actually had the government put an additional 5% into retirement savings into the S&P 500 for every American? Well, then the answer is, of course, we're going to see much higher returns and fantastic returns, right? So it really is flow dependent. And that's it's a super complex communication.
What if we you've had I've seen some of your really good commentary on U.S. economic fundamentals. If we hold flows neutral, just forget about flows. What do you think about U.S. market expected returns based on economic fundamentals?
Well, so this is, unfortunately, I think there's a whole host of separate issues as it relates to U.S. economic fundamentals tied to the pandemic and the behaviors that we have around the pandemic, and then more broadly to a discussion of what societal wealth really is, right? So when you think about societal wealth, it's very easy to add up the dollar value of all the buildings and all the companies and all the cars we own and the dishwashers we own, et cetera, right? Those are all, certainly contributors to our quote unquote wealth. But remember, that's just an accounting entry, right? A car is worth $30,000. Well, I mean, that's true until you have to, you're dying of thirst and then you're willing to trade your car away for a glass of water, right? So these are all just, simply accounting entries. The real value that exists across the world is in human capital. And every corporation gives lip service to this. Our most valuable assets go down the elevator every day, right? Now, we negotiate against them as much as we possibly can. We try not to pay them reasonably. And in fact, if you're Apple, we're going to engage in outright, collusion with our peers to make sure that our employees are underpaid relative to the value that they're creating. And we, of course, forgive that. But, that human capital is really the value. And unfortunately, because we don't measure that in any way, shape, or form, I'd suggest that almost every metric that we have is deeply distorted. If I look at that human capital component, I would suggest that both in the United States and Canada, we're seeing a significant dumbing down of the general population as our educational institutions increasingly fail. We're looking at an increasing failure in terms of our healthcare systems and our ability to keep people alive and healthy and in good spirits for an extended period of time. We're seeing a society that is becoming increasingly fractured in the United States and Canada across multiple metrics, right? And so all of those should ultimately play into the valuation that we ascribe to assets. And yet, ironically, we don't include those. So we're not thinking about that underlying dynamic. On that basis, I would simply point out that the US is far less stable than it's been at periods in the past. And as a result, you should be applying a country discount versus history. We're doing the opposite.
Man, yeah. So people investing in U.S. stocks, they shouldn't get out on either the index fund or the economic fundamentals piece. Still be an index investor, I guess, but maybe don't count on the recent returns repeating forever when you think about your future.
Yeah, I mean, look, that is the core issue, right? And most people have kind of woken up to the giant joke. You can't allow a retirement system to fail. And the US markets have become our retirement system.
Right.
And so the US government is going to be forced to intervene. Now, ironically, if we know that the US government is going to be forced to intervene, that makes us more comfortable investing. Therefore, we push prices up higher, which in turn means a larger sell-off is required for the US government to intervene, right? And how the game plays out in that moral hazard, I got to be honest with you, is beyond my IQ.
Man, I think it's beyond everybody's IQ.
No kidding.
That's a big one.